Hey everyone, Sterling here from Day Trading Forex Live, and I'm excited to bring you the trend exhaustion reversal setup. We get a lot of emails from members that have a full-time job. They're not able to trade during the day. They really have a limited schedule. I think that's common for a lot of people, but they want to get into the Forex market. You know, their job's not going well, or whatever the case may be. They want to get into the Forex market, understandably, and they need something that allows them to capitalize on these moves, but not take up a large amount of time. Now, because in general we have our members that trade the smart money strategy based on a lot of different criteria, we have members that do a lot of different things. One of the things that is a strategy that is used for end-of-day type trading is the exhaustion reversal setup, and it's used to spot the weekly reversal. So the first thing you have to do is you have to say, when is it the probability of that weekly move being done? Well, in order to do that, we need to understand how the banks run the market on a weekly basis, or how they trend the market. I recommend you pause the video, grab your pen and paper, write it down. First and foremost, we know that the banks trend the market in cycles of 3. So what we look for is first and foremost, we look for a cycle of 3 separate cycles. Well, let's define those cycles. We want to see those cycles being at least the average daily range, or 90 pips. Whatever one is smaller is fine. If the average daily range is 70 pips, well then 3 70 pip cycles is fine. Now if the average daily range is 150, as we had, maybe back in 2008, then we could go with 90 pip cycles. So 3 cycles, and seeing those cycles at least being each 90 pips or the average daily range, whatever smaller. Third point, have these cycles occurred over 3 or 4 days. So there's a time limit there. We don't want to see it occurring over 12 days, and we don't want to see it occurring over a day and a half. We, in general, want to see 3 to 4 days. That's the third point. Now, the fourth point, was that move overall, was it 150 pips or more? So we want a base criteria. So what we're saying by that is from this low here to the overall high, whoops, let me draw that out here, to the overall high, was that 150 pips? Well, measuring this move, that move was about 178 pips, definitely fulfilling that criteria. Understand, guys, that in the Forex market, a little common sense goes a long way. If the move is 149 pips, let's use a little common sense and understand that we're looking for the principal. The principal is key in everything that we do, and especially in identifying the weekly push as well. So first criteria, 3 separate cycles. Those cycles need to be at least 90 pips or the average daily range, whatever is smaller. We need to see that cycle, those 3 cycles occur over 3 to 4 days. And was the pip count from high to low, or from low to high, depending on the direction, was that move at least 150 pips? Well, this satisfied the criteria. So what we do is, once we see the first 2 cycles, then on the third cycle, when we're expecting the third cycle to occur, we begin looking for what we term as a trend exhaustion reversal candle, a specific candle that's going to give us the indication that the banks are creating a false move. When the banks create a false move, they do that with a purpose. They do that with the purpose of either inducing buying pressure, so they can buy into those that are, or excuse me, they induce buying pressure so they can sell into that buying pressure, or they induce people to sell so they can therefore buy from those that are selling. So the first 2 moves have occurred. We're looking for that third push to occur. And on that third push, we know that the possibility of a trend exhaustion reversal candle is possible. Let's define a trend exhaustion reversal candle. A trend exhaustion reversal candle, as a very basic criteria, is on average twice the size of the candles that are around it for the last 24-hour period. Now, you can identify that in a few different ways. You can take an average true range indicator and look at the last day, or which would be the last 24 periods, 21 periods, whatever you want it to be. You want a general average of the last 14 to 24 hours in that range. Again, a little common sense goes a long way. You can look at this candle here, and I'll draw an arrow to it. You can look at this excessively large bullish candle here, and you can tell me that that candle is at least twice the size of the average candles around it for the last day. I think that's a pretty common state, or a pretty a pretty normal statement to say that, and that is the base criteria that we want to see. And so going forward, that's the base criteria you want to see for an exhaustion reversal candle. So you've seen 2 cycles, you're looking at the 3rd cycle completing itself, and then you see a candle that is excessively large as compared to the candles that are around it for the last day. That is the key for an exhaustion reversal candle. We'll explain why and what that candle means here in a minute. Now, after we see that candle close, do we know the move is going to stop? Well, no, we don't. The move could very well, in this case, it very well could have continued to the upside. Therefore, what happens next is absolutely critical. What we have to see next is we have to see that move get completely retraced by the end of the New York session. So I don't mean by 5 o'clock. In general, 5 o'clock at the latest, but by by noon, 1 p.m. or 2 p.m. Eastern time, New York time, I want to see that exhaustion reversal candle completely retraced. So when we look at a day, our trading days are from 2 a.m. in the morning to, in general, 11 a.m. in the morning, Eastern time. That's New York time. So if the move starts, if this 3rd push started at 2 a.m., say, and this exhaustion reversal candle came at, let's say, 8 a.m., I want to see that exhaustion reversal candle completely retraced by noon or 1 p.m. or 2 p.m. at the very latest. I want to see that move getting completely retraced. Okay, so let's break down why we want to see that. It's important to understand why and what the banks are doing at that point. What's happening during an exhaustion reversal candle? In order to understand that, we have to understand the base criteria of how smart money moves the market. They move the market by accumulating a position. They then allow the market to trend and exit the position while the market is trending, thus closing out their position for a profit. Therefore, smart money has an accumulated long position somewhere near the beginning of that move. Really doesn't matter exactly where their average entry point is. But we know that because the market was moving up, if they're profiting from that move, they had to be long. And in general, because they dictate trend, they enter trends at the beginning of that trend. Therefore, if their accumulated long position had an average entry somewhere in this red box, then what we know is they need to exit that position. Now, they don't enter positions instantly the way you or I do. They accumulate positions over time. They must find buyers if they want to sell, and they must find sellers if they want to buy. They have a massive position. They take up a massive percentage of the volume every day, and therefore they need to create artificially buying pressure when they want to sell and selling pressure when they want to buy. So if they're long, they need to exit that position. How do you exit a long position? The way a long position is exited is you have to sell that position back to the market. If you want to sell that position back to the market, you must have an equal amount of buying pressure in order to close out that sell position. If nobody is willing to buy the position that you're desiring to sell, you cannot exit that position. Therefore, by creating an extremely aggressive market, what that does is that induces the rest of the market to pile on long. Remember, we have a trend behind us to the upside. We then have now broken through these highs, triggering anybody that's buying on the breakout, inducing further buying pressure from just the general aggressive nature of that candle. There's many strategies. We're not going to get into the different hundreds of strategies, but as that market begins to propel to the upside, especially as aggressive as it's moving, you have the rest of the market that begins to pile on, assuming that that move is starting to the upside. So as that happens, as the rest of the market begins to pile on to the long side, they begin to drive that market even faster to the upside. That's where smart money begins to sell into that buying pressure. And that is why it's critical that move gets completely retraced. By that move getting completely retraced, that tells us that, in fact, yes, smart money did begin selling into that buying pressure, and they sold into everybody that bought into that false break. Now, that's why the reversal in this case, and the complete reversal, is so critical to telling us that with a high degree of certainty, the banks were selling into that false push to the upside. What made this move so great as well, as we zoom out, or we actually will zoom out just a bit, we look at this last high here. We actually, not only did we see an exhaustion reversal candle, but we saw a stop run as well. We saw them in, we'll zoom back in. So you can see there's a very clear hourly high back on 22nd of October. But you can see the market broke through that high, inducing again any further buying pressure. Not only that, but just right below this point right here is one spot 3,000, a major psychological barrier. So they broke through all those points, triggered any stops above that point. Again, if somebody is short, they have to buy it back. So they're triggering all those buy orders and immediately selling into those buy orders. And that's why it's critical for them to reverse the price, completely retrace the exhaustion reversal candle, and that gives us a strong indication that smart money was selling into that buying pressure. Now, after we've identified that, that's critical. But that's not where the trade's taken. We sit back, we look at the trade, we examine it. Is all the other criteria we've discussed satisfied? Do we see the 3 individual cycles? Has it happened over the course of 3 or 4 days? Are each of those cycles hitting the general pip count we want to see? Is the overall move at least 150 pips? Was that exhaustion reversal candle, on average at least twice the size of the candles around it for that day? Did the exhaustion reversal candle that came at the end of the trend, did that happen to get completely retraced by the end of the day? Well, if all that criteria is satisfied, then what we do is we watch the Asian session the following day. So we watch that Asian session the following day, and you can see I'll drag this arrow down here. And we'll look at this Asian session. The Asian session is this gray box on a 15-minute chart. Zooming into the 15-minute chart there. Let me go back. So we look at this on the 15-minute chart. And what we want to see is we want to see a 15-minute stop run of the key level during that day, or the key level from that Asian session. Now, in this case, notice how well the market responded to these Asian session highs. I don't think I have to tell you guys that a very common strategy is to place a stop is your stop goes, if in case of being short the market, if you're short the market, your stop goes above the last high, and if you're long the market, your stop goes below the last low. You guys know that. It's a common strategy that's taught in many different entry strategies. Many people use that for an exit strategy or a way of placing the stops or moving the stops as the market trends in their favor. And that's what we have here. We have the market come down, set a fresh low, and what that does is anybody that's short, what they're going to do when the market sets that fresh low or when it begins to move off to the downside is they're going to put their stop just above that last high. Very common strategy. That is the Asian session high as well. The stops go just above that high, and as we see them come to take out the stops, that is the final last bit of information that actually triggers the entry. The trade is taken from that point. That is a double confirmation that smart money is accumulating the positions. They're manipulating the market. They're driving the market into areas where they know they're going to find retail orders. And in this case, selling into buying pressure that's created through their manipulation. If you don't understand this short-term stop run, there's a lot of information on Day Trading Forex Live. You'll find the link below the video if you're on YouTube. A lot of information to understand the stop run video. And you can get a little more information on that to fully understand the 15-minute stop run and understanding manipulation as a whole. So what we're going to do now is we're actually going to look at a current setup. We're going to look at the dollar CAD. We'll zoom over the dollar CAD and we'll see what we have on the dollar CAD as well. Well, first and foremost, we have 3 individual cycles. Now, the dollar CAD does move a little bit less, so I give it a little bit more leeway. Now, the overall move on this is still 160 pips. But we need to understand that individual pushes on the dollar CAD will be less than they will be on the euro dollar or on the pound dollar, but still this was hitting that overall criteria. Seeing the moves, getting in the average of the getting in the range of the average daily range. And this move is occurring over just about 3 days. Now we have from this block to this block is 1 day, 2 days. Now we're coming up on 3 days. And Actually, this move was started a little bit before that, so it is coming up on 3 days. Again, that average right there in the 3 to 4 day range. If we see it a little bit shy or a little bit after, that's okay. We're using some common sense here. We look at the average of how they tend to move the market. So again, 3 individual cycles. We've seen those 3 clear individual cycles. Those cycles have moved at least the average daily range. We're seeing it occur over, on average, 3 to 4 days. And that overall move is at least 150 pips. If this was even a little bit less than 150 pips, because it's the dollar CAD, I would have allowed for it, understanding that each pair moves a little bit different. If it's the euro pound, you're going to have to allow even more room. The euro pound does make a much smaller move than, say, the euro dollar or the pound dollar. So on this third push up, what do I see? Well, I'm not 100% fond of that candle here in between, but I'm going to zoom in a little bit. And if you go back and you look at the average range of these candles here, this candle is just at twice the average range of the candles that are in and around it over the last 24-hour period. So looking at that, you see a candle that is aggressive in nature. It's, again, larger than the candles around it, twice the size of the candles that are around it, looking back to the left here. And then we see a complete retracement of that candle moving forward. We don't want to see we don't want to see a further close higher. The market can break a bit higher, as we discussed in the article. We do not want to see a close higher. We see that move completely retraced, and so the stage has been set. We have all the criteria for the weekly trend to be finished. But now what do we use for that last bit of information? Again, we're going to zoom into a 15-minute chart. Now looking at the 15-minute chart here, we see a very clear high. This is Sunday. We have a Sunday session high. So what we're going to look for is we're going to look for the market to come back into these highs. We're going to look for it to take out those highs and then get rejected from that point. The great part about this strategy is there's another fail-safe built into it. You know, using this second day allows us to have the market, if it doesn't come up into this level, create either the stop run through it with the reversal legs that are breaking. For example, reversal legs would look like this. Maybe they break up above it, and the next candle immediately starts and retraces it. Nice set of reversal legs. Or what we could see is we could see the market, and I'll draw this out here. We could see the market, and you have to excuse my candle drawing ability here, but we could see the market come up, imagine that as a nice shooting star candle formation. Either way, we want to see the manipulation of that level. That is a high probability level, and if you don't understand high probability level, definitely go through the site. A lot of information on high probability levels. So either way, we want to see the manipulation at that point, start to get rejected from there. That's where the entry is. If we don't see the manipulation, the trade is not taken. What do I mean by that? Well, let's say, for example, the market starts to work back up. Imagine these as blue bullish candles, and imagine the market just works into that point and never shows any sign of reversal at that level and just continues to break through it and never responds to, even we have a little bit deeper level that we could respond to up here. Nice clear level that we could see retail orders sitting around. But let's say we blow through both of those levels. If we never see the manipulation at a high probability point, then the trade is not taken. That's really the key. There's a lot of fail-safe built into it. And what that does is that allows us to eliminate a lot of trades that would end up in taking a loss. It allows us to just narrow it down to the best trade setups and really keep us from getting into the ones that are going to result in a market that would move against us. The key here is to be very selective. If the criteria is not satisfied, you move on. This is a great strategy for those that have a limited amount of time, or those that have a strategy already, but just want to add another strategy to it. Or what this can do is also give you an overall bias for the day that you can then use for your shorter term strategy. So it's really key. We have a lot of members that are absolutely killing it with just the weekly trend exhaustion reversal setup, doing great with just this setup in and of itself. So try it with what you're using, whether again it be a standalone or with what you're already doing. So I'd like to urge you guys to go check out the article on the site if you haven't. If you're watching on YouTube, you can see the link below this video, and it'll link back to the article that is covered on the site. If you don't understand anything in this video, whether it be the terminology that is used or different criteria, stop run, any other thing you don't understand, feel free to contact us. What you can do is you can hover your mouse above the About Us page on our site, see the Contact Us page, shoot us an email, chat or are happy to get back with you and answer any questions that you guys might have. We really hope this video helps you. And as always, guys, until next time, happy trading.